Bonds have been the favorite for investors since the stock market crashed in 2008. Of course, a lot of the fanfare for bonds was because the Federal Reserve cut interest rates to nearly zero in 2008 and bought trillions of dollars worth of treasuries and mortgage-backed bonds since then. The demand has pushed yields to record lows across the spectrum from treasuries to non-investment grade bonds. But there's talk the Fed could pull back on its bond purchases sooner than thought. And investors have been swift to dump treasuries and other sorts of bonds. So should you be exiting bonds now? Here to weigh in is Wilmer Stith, bond fund manager for Wilmington Trust, and Jim Sarni, managing principal and senior portfolio manager for Payden Rygel. Gentlemen, welcome. Thanks so much for joining me.
Thanks for having me.
Thank you.
We're starting to see a lot of volatility in the 10-year yield, just as the Fed is even talking about dialing back purchases, right? Not ending the program, let alone selling its purchases. Will, is the last run in what's really been a 30-year bull market in bonds ending?
Well, we don't necessarily know if it's going to be ending, but what we do know is that there are still so many uncertainties that could really push yields lower. There could be Europe, dismantling of the euro, problems in the Middle East, just continued anemic payroll growth within the United States. So all those things sort of leave it an up in the air type of question. But what I will say is that given the amount of easing that the Fed has sort of initiated over the last several years, it's really prudent, we feel, that you really have to take some of the risk out of your portfolios at this juncture.
Jim, what's your sense? Is the 30-year bull market in bonds over? Are we seeing a sea change here?
Jennifer, I don't think so. I agree with a lot of the things that Will just said. I think it's premature to say that this is the beginning of the end for the bond market. There are still many uncertainties out there. Things have not really changed in most of Europe. Europe is still a pretty fragile place, and I think that bonds are going to continue to be a safe haven for investors around the world. So I don't think the bond market, the game's over yet.
Will, coming back to the yield on the 10-year for a moment, we saw it jump from 1.6 to 2.1 just in the span of May. It seems to be holding in around 2%, but you said that there is a chance that yields could actually go lower here on fears perhaps in Europe or other places around the world. What's your sense of where the yield on the 10-year is going to be going here in the next couple of months, second half of the year?
Well, we think over the longer term, yields will be moving higher. The next major support level for the 10-year yield is around 240. That's the high in yield last year. So we got recently at around a 2.23. Like you said, we're closing in New York time at around 216, 217. So we still think the trajectory is higher. We just don't necessarily think it's going to be, so violently high as, say, 3-4% yields on the 10-year. For the same reasons that Jim spoke of earlier.
So then it's fair to say that a 1994 scenario, which we've heard chatter for, where rates had to come up very quickly, right, spurring a major bear market in bonds, is probably a low probability at this point.
We think it is somewhat low. We just think sort of that the volatility in the market probably will be with us here as the market sort of second guesses, well, wait a minute, are they tapering sooner rather than later? And as such, you just want to, in our opinion, get out of those sectors that have performed very well over the last several years, get out of those sectors that sort of have built-in optionality in them, whether it be mortgage-backed securities, high yield, tip securities, and just really sort of circle the wagons, if you will, and just wait until we get more clarity on which direction the Fed is in fact heading.
Jim, where do you see the yield going on the 10-year? I mean, do you expect a lot of volatility here going forward, depending on what the Fed decides to do?
I do, Jennifer. I see volatility. I think that it's important to keep one's eye on inflation. And, in terms of where rates could go, I know Will says possibly 240. I think that's a little bit on the higher end, but I would agree generally that that's about as high as they can go, because inflation, despite what the Fed would like to see, which is higher inflation, is actually going the other direction. The latest read that we got was that inflation at the producer level is running just a little bit higher than 1%, and the Fed would really like to ultimately see that closer to 2.5%. So then when
would you expect the Fed to begin tapering, right? To your point, since inflation is low, that kind of gives them a little more leeway, right? Or I guess my question is, has the bond market overreacted here?
I think the bond market has overreacted, and it does. That low inflation rate and the disinflation that we're seeing actually does give the Fed some more wiggle room to keep doing what they're doing, keep purchasing until inflation starts to move up a little bit.
Will, obviously we've talked about how the yield on the 10-year has started to rise, and that's putting upward pressure on mortgage rates. I'm wondering, do you think we've seen the low for mortgage rates?
That's a very good question. I think we may have seen the low mortgages. It's a an irony that since the Fed came out with their QE3 announcement and said that they'd be buying $45 billion each month in mortgage-backed securities, that sector of the bond market has been actually very disappointing. We have negative excess returns. And so not only is the risk-free rate moving slightly higher, but so too is the spread of mortgages. And so, I think the 3.5, the 3 and even a quarter, I think I saw printed in some cases on a 30-year conventional mortgage. I think that train has left the station.
Jim, what's your sense? You think we've seen the low on mortgage rates here?
I think we have seen the low in mortgage rates, Jennifer, but I also think that with rates having moved north of 4% and possibly moving a little bit higher, that there's going to be tremendous political pressure to try to do for the Fed to try to do what they can to keep rates low. Because when you think about it, the housing sector has been one of the positive pockets of the economy, if you will, and has really helped to generate some growth in the economy. And with mortgage rates moving significantly, if they were to move significantly higher, the housing market could stall out, and that would counteract what the Fed's trying to do with growth.
Yeah, that's a good point. All right, well, let's talk about what bond investors should do now. Will, what are your recommendations? And I guess when we talk about the bond spectrum, right, there's treasuries, there's corporates, there's investment grade, non-investment grade, and then, of course, international. Would you be doubling down in certain areas, perhaps letting up in others?
Well, at Wilmington Trust, we really want to make sure that we're taking really the best approach to risk-adjusted returns. And given this, where we are with the tapering issue, where we are in the economy, it really goes back to what I was saying earlier about sort of circling the wagons. Mm-hmm. So you have slightly lower interest rate risk than your benchmark. You're taking some of the more volatile corporate securities out of the portfolio. You're taking away some of the optionality, reducing mortgage-backed securities. And as Jim pointed out, with inflation being so low, you're really, we would recommend that you get out of Treasury inflation protection securities, or TIPS, and really focus on nominal Treasuries in that 3 to 4 year part of the yield curve as sort of a safety zone. Because while they're talking about tapering, I think it's very premature to suggest that they're going to do anything with the federal funds rate. And so if they're not doing anything with the very short end of the market, Jennifer, I think investors have some safety in that 2 to 3, perhaps 4 year part of the curve.
Yeah, I wonder if you should shorten durations now.
Absolutely. We have shortened durations, and we continue to be short duration here.
Jim, what are you doing now? How are you positioning your portfolio?
We still think that yield is going to be the name of the game for lots of reasons. Even though yields have moved up a little bit, in the big scheme of things, yields are still historically very low. And we think that they're going to stay relatively low. And as a way to weather this volatility storm that both Will and I have been talking about, yield is going to be a nice cushion. And with respect to that cushion, I think that one of the best cushions these days in the bond world is high yield. The economy is proving high yield bonds. There are many companies out there that have strong balance sheets. They are doing a great job of managing their debt. And it still is possible to get yields depending upon maturity, in the 3.5 to 5.5% range. And I think that's going to be a nice way to weather this storm.
Well, how do you feel about high yield? I mean, last we spoke, I guess it was November. You said the lily was off the vine.
Yes, and when you look at returns year to date for high yield, I think, Jim, correct me if I'm wrong, I think they were close to 6-7%, just astronomical, great performance. But as of this morning, we were below 3%. So a lot of that return has come off. In addition, a lot of retail investors should really take note that in the high yield market, there's a lot of call risk involved with these securities. And so, the average price of the high yield market now is a $104 price. And so some of those constituent bonds are a lot higher than 104. And so if we get a lot of volatility in interest rates, investors, retail investors particularly, could all of a sudden see a bond that they purchased at a significant premium be called away at par. And that's one of the reasons why we feel the optionality in high yield. It's more of a technical reason why we are somewhat skittish on high yield at this juncture. A lot of outflows. I think when you read the papers over the weekend, over the weeks to come, you're going to see a lot of outflows starting to make some noise in the high yield space and also in the investment grade space. So that's something that we're a little cognizant of. We would prefer and continue to be overweight in the investment grade corporate space. We agree completely with where Jim is coming from, that investors are going to have to be searching for a yield here. That problem is not going away.
Well, I want to hear Jim's
response. But on a risk-adjusted basis, we like investment-grade corporates over high yield.
Well, we're negative, right, Will, on investment-grade corporates year to date. I mean, at what point do retail investors who are paying more attention to absolute returns versus relative returns kind of say, okay, it's time to throw in the towel?
Well, we don't think you should throw in the towel. There's some, you can't sort of paint the entire investment grade space with one brush. There's certain parts of that market that are doing very well. The banks, finance continues to do well. Let's say they do start to taper and interest rates do rise more significantly. We think it'll be a steeper yield curve. And who benefits from a steeper yield curve in a growing economy? Well, it's going to be the banking sector, so the finance sector. So it's not as easy as it was just 3 weeks ago or a month ago.
Right.
You really have to be more specific on where in the investment grade space you want to be placed.
Right. Jim, do you want to respond to Will's comments on high yield?
Yes, I do, Jennifer. And I would say that in addition to Will's comments about banks being the beneficiaries of a stronger economy and higher rates, by the same token, history has shown, and we don't think that the future will be significantly different. Absolute yield levels are different, but history has shown that high yield has been a nice haven from rising interest rates. In fact, we've gone back and looked at past periods of rising rates, and if we go back to say the 12-month period ended in 04, rates rose, 10-year Treasury yields rose about just under 1.5% over that time period, and high yield, despite the rise in Treasury yields, returned over 13% versus investment grade bonds during that time period, which returned significantly less than that, somewhere right around just slightly positive returns. Likewise, in 06, same thing. Treasury yields, a 12-month period ended 06. Treasury yields went up about 120 basis points, and high yield was up about 4.5%, the broad market, and investment grade bonds were about flat for that same time period. So they will do well in a stronger growing economy, as well as provide, I think, some kind of a haven from rising rates.
All right, gentlemen, we are out of time. We'll have to leave the conversation there. Thanks so much to both of you for being with us. We'll see you soon.
Thank you. It's nice to be here, John.